Hello, my dear students. So today I'm going to explain to you question number 1 related to your absorption costing. We will study up the format and the ways of making your absorption income statement. So I'm going to begin now. Here's my presentation. Goes up here, Alt T. So we're going to begin. Here's my PowerPoint presentation. Okay, we're going to begin now. So let's begin. So question number 1 is related to production not equal to normal capacity. Question number 2 and 3 is production related to normal capacity, which I've taught you yesterday. And so today we'll be basically discussing on question number 1. 2 and 3 I have already given yesterday. So let's move forward. So income statement under absorption costing. Step 1, or the most important step in solving absorption costing, is you need to make the production cost per unit, or you need to calculate production cost per unit. Now this is very simple. If you remember this mnemonic code DMAIL-VFM, I will tell you what it means. So let's have a look at this code DMAIL-VFM. Here D represents direct, and MEL-VFM. M represents material, E represents expenses, L represents labor, VFM, V represents variable manufacturing overhead, and F represents fixed manufacturing overhead. So here what you need to understand is that the manufacturing overhead is divided into two categories, the variable part and the fixed part. So when you calculate production cost per unit under two methods, the absorption costing and the variable costing method, you will notice that there is a difference in the fixed manufacturing overhead. Absorption costing assumes the fixed manufacturing overhead as part of its product cost, while variable costing does not consider fixed manufacturing overhead as part of its product cost. This is the basic difference between the two methods. So here we have production cost per unit as 50 and here is 40. Variable costing is also called marginal costing, so you shouldn't get confused about it. Let's move forward. Basics for income statement under absorption costing. So while making your absorption costing statement, you might have to adjust this under / over absorption of fixed manufacturing overhead. Now this heading arises only in your absorption costing statement. It does not arise in variable costing statement. Now in absorption costing statement, it arises under this situation only. The situation is when your actual production is not equal to budgeted production. We'll be doing about this we'll be doing about this in this example. Some budgeted production is also called normal capacity. So let's move forward. So the steps for solving. Number 1, you need to find the production cost per unit by using the code DMAIL-VFM, and you might have to find the fixed manufacturing cost per unit if it's not given in the question. So the formula to obtain your fixed manufacturing cost per unit is your fixed manufacturing overhead divided by budgeted units or normal capacity, whichever is given. Then you need to find the missing inventory. The missing inventory formula is opening stock plus production equals to closing stock plus sales. If you use this equation, you can find any of the missing data. Third, we will follow the income statement format. And in fourth, you will calculate under absorbed fixed manufacturing overhead if it is there in the question. You'll have to subtract it. In case you get over absorption, you will have to add it. So why, that we'll study in the example. Let's move forward. So this is a case where actual production is not equal to budget units. Now in this case you will have over absorption or under absorption of fixed manufacturing overhead. In other cases you will not have. So we move forward. So this is an example. Samyam Limited manufactures one product. The following information is available. So we are given direct material, direct labor, selling price, budgeted fixed overhead, budgeted productions, variable office overheads, fixed selling overheads. The following information is available for February and month and March 2019. Actual sales for February you have 13,000, actual production 7,000. So same way you have for March. Now question is asking you to prepare income statement under absorption costing for each of the month February and March. I will be focusing on the February. You will have to try to solve for March, though the answer is in this presentation. Okay, let's begin. So this is our income statement format. This is our income statement format. Now if you want to understand this format, you can look at one more format of income statement. This is what we studied in our final accounts chapters, financial statements. So income statement, basically on the heading in the top most portion you have sales, then you deduct cost of sales, and then when you deduct cost of sales you get an unadjusted gross profit, or you can simply say gross profit. Now why I'm saying an unadjusted gross profit is because in this question you might have to deduct under absorption of fixed manufacturing overhead. So if there is such data, you will have to deduct it and you get the real gross profit. So when there is no this heading, you can say this 70 as the gross profit itself. Then we deduct all other expenses and then you get your net profit. Mind my spelling out here, I missed the S part. And to get the cost of sales, the formula is opening stock plus purchase minus closing stock. That's what we studied in our trading account. Here we will use the same formula, but we will replace this purchase by production. So your cost of sales out here is going to be opening stock plus production minus closing stock, which we will look here. So let's have a look here. So if we have a sales up here, less manufacturing COGS, this means cost of goods sold. You can say cost of sales is the same thing. So you can see the opening stock is here, the purchase has been replaced by production cost, and then there's closing inventory. So if you look here, opening stock we add with the production and then we deduct closing stock. This bracket represents minus. So when you solve this part, you get 1,44,300 as your cost of goods sold, manufacturing cost of goods sold. And when you deduct from the sales, you get your gross profit before adjustment. In this question there is under absorbed fixed manufacturing overhead, so we deduct it and you get a gross profit. Then we deduct the expenses. Here we term it as the non-manufacturing cost of goods sold. So all of the expenses are deducted here, and then you get profit for the year. So now let's see how the whole thing is solved. First thing what we do while solving this question is we calculate the production cost per unit based on our steps. So to calculate production cost per unit, remember the code DMAIL-VFM. So direct material, if you look up here, there's direct material 3.2 I put here. Direct DMAIL, direct expenses, there's no expenses out here, so it's not here. Then direct labor, you can see direct labor here, it's been put here. Then variable fixed manufacturing overhead. If you look in the question, there is no way stating variable fixed manufacturing overhead, so it's not there. Then we need fixed manufacturing overhead. Now fixed manufacturing overhead is also not given directly, so we need to calculate it using this formula down here. You can also call it fixed overhead. So fixed overhead per unit, or your fixed manufacturing overhead per unit, is obtained by using the formula budgeted fixed overhead divided by budgeted production. So let's look at up here. You have your budgeted overhead 88,000 and then budgeted production 16,000. When you divide this, you get 5.5. This amount you put here. and then you add this up, you get 11.11 as the production cost per unit under absorption costing. If you are asked to solve this question in variable costing method, you will not add 5.5 here and get your answer as 5.6 per unit. That's the only difference in these two methods. However, we'll be focusing on absorption costing. So production cost per unit is 11.1. Now this 11.1, where do you put it? That's the question. Let's go back to income statement. So in the income statement, there's your opening inventory, the production units, and then there's a closing units. This data you need to solve first. So to solve it, you can look down here. I put a working down here, the missing inventory calculation. That's your opening stock plus production equals to closing stock plus sales. Opening stock, if you look for the month of February, opening stock is not given, so I put 0, though sometimes you could get as missing figure. Let's assume that this is not 0 for a while, so put the data that are available first. Sales, we have 13,000, put down your sales. 15,000 is a production, put here. So if you look at the both side, you can notice that the closing side is the right hand side is 2,000 less, which is your closing stock, and that's a missing figure. So if the right hand side is less, it means you don't have opening stock, so you put 0 out here. So here we have production, closing stock, and then sales in units. So this data will be putting up here. So opening stock, we have 0, that you multiply with the production cost per unit, which we just solved. Production units, we have 15,000. You can look up here or you can look down here, it's the same thing. 15,000 into 11.11 production cost per unit. And closing stock, we just found the missing figure 2,000. You put it here and then you multiply with the production cost per unit and you get your answers as this. You don't have opening inventory, this is your production cost, and this is the closing inventory. That's I put in bracket because we need to subtract it. Remember the formula of COGS, opening stock plus production less closing stock. So this gives you answer as 144,300, which is your COGS. So when you deduct from your sales, you get your gross profit before adjustment. So far we have understood. Now there is another method of calculating your cost of production. This I'm showing out here. If you don't want to use this technique, you can also adopt this technique. Like here what I've done is direct material, I found the full amount here. Direct material, you multiply with the production units. The units produced is 15,000, so 15,000 is 3.2. This rate, you multiply it, you get a direct material cost. Direct labor, same way you multiply with production units, you get 6,000. Remember, we are multiplying all by production units. Then variable manufacturing cost we don't have, so I put 0 here just to make you understand the format. Then fixed manufacturing overhead, we derive 5.5. You need to take this out first anyhow, so you got 5.5 here. You multiply with the production cost, production units, you get this as your fixed manufacturing overhead. And then when you add this up total, you get your production cost. Manufacturing cost of production, that's your production cost. This amount is exactly same as this. Notice this. See, isn't it same? So for this line, you can also solve by this method without making this table. It means you'll have to replace this whole data in place of this production cost. So you'll have formula like opening inventory, this will be your same situation. Then you will put your direct materials, direct labor, variable manufacturing cost, and then fixed manufacturing overhead under this heading. And then you will get this data 166500 in this part. Then the opening stock, what we can do is first we can solve this in this part, in this section. Then you can put your opening stock. We don't have opening stock 0, and this rate, the rate how to get it, that's the question. To get this rate, you have two options. Either you can add up this 3.2, 2.4, 0 and 5.5, the rate markings, and get 11.5, or you can divide 166,500 by 15,000. If you divide it, you will get 11.1. Now this is important because you need to put this rate in your opening stock and closing stock. Clear? So in opening stock, we don't have opening stock, so 0, you put the rate here, you get this. Closing stock 2,000, you have this rate, put it down here, and then when you solve this, you get 144,300 as your COGS, which is exactly the same. See this and this. So it means the whole this section can also be solved by this method if you want it. Okay, let's move forward. So anyway, I advise this method as the better method. We will do this. If you are given per unit data, this looks, you know, it looks like it's I mean it saves more space. You could do this in the working. So let's go forward. Sorry. So there's another method of calculating your cost of goods sold. This amount 144,300. There's another method. The other method is by simply multiplying your sales units. Our sales unit is 13,000. Remember, 13,000 into your production cost per unit. This one, if you multiply it, you get the direct amount. This amount, see there? It's very simple. So it means here we don't need to take the trouble of calculating opening stock, adding up production cost and then deducting cost of sales. You can simply multiply your sales unit. This is 13,000. Sorry, I missed out 1 0 out here. You will get the same amount, but this is possible only when all rates per unit are same. Means you will have to have this 11.1 same for all three datas. If the opening stock rate is different, you cannot use this formula. Now this is not possible to use in your second year, or if you are using for the second month, it might not be possible when you have an opening stock in the second month. Okay, so let's move forward. So now we are going to focus on under absorption and over absorption of fixed manufacturing overhead. This section 5500, how to get it. So to get this is very simple. First you write your budgeted fixed overhead, that's given 88,000. It was given the question. If you look out here, yes, here. This 88,000 is for 16,000 units. So for 16,000 units, the budgeted fixed overhead is 88,000, but we have actually charged 2,500 in the income statement, which is for actual production. This indicates that we have not charged 1,500. Means 1,500 still needs to be charged as an expenses, because fixed overheads are expenses regardless of whether you produce or not produce goods. So to this extent we will deduct it. You would write a less under absorbed fixed manufacturing cost, and then subtract from 88,000 minus 15,000 to 5.5, that's your 82,500. If you deduct it, you get 500. Clear? So that gives you the gross profit. Have you understood why we are deducting the under absorbed fixed manufacturing cost? It's because the budgeted fixed overhead is 88,000, while if you look up here in the fixed manufacturing overhead, we have charged only 82,500 in our income statement, which means we have charged less. So that's why the undercharged amount is being charged or deducted. Okay, moving forward. So after getting a gross profit after adjustment, we deduct the non-manufacturing cost of goods sold, which are this part, the variable office overheads. These are not involved in production, so this comes here. You have to multiply with the sales unit. Remember that it has to be multiplied sales unit, not production units. So when you multiply this two, you get 8450. And then fixed selling overhead per month, since we are doing monthly calculation, so fixed selling overhead, you put your 2500 as fixed, add this up, you get a total non-manufacturing COGS, and you deduct it, you get profit for the year. That's how we solve it. So try yourself for March. So for the month of March, this is the question out there. Just brought back the question. This is your answer. I want you to pause the video and try yourself. The only difference here is you'll have to be careful with this part, calculation of missing inventory. The closing inventory of February becomes opening inventory of March. So this is 2000 here. Then you have oops, what was it? I put missing finger here. What is this? 15, 16, 17. This is not question mark, I'm sorry, there is no missing figure out here. Please avoid this missing figure and question mark. So this 2000 comes as opening stock from the previous month, and then you have your production as 15,000 if you look up here, and then you have sales as 7,000. Now there is no missing figure out here because both sides are equal, so closing stock is 0. However, this missing figure and question mark, there is no missing figure in this question. So that's the only difference. The closing stock of previous month becomes opening stock of current month. Say the format where, but in exam you will not have sufficient time to do like how it is done here. So let's see how it's done in exam, because we don't have so much space to write all the details. So this question is extract of your 976 May June 23 question 2015. So in question number 3, so that's your question out here, that's your answer out here. I'm just going to say it quickly. So income statement has been prepared for 2 months as February, March, because you don't have enough space to do it twice. So sales, you can easily understand how it came. So you'll have to calculate the production cost per unit under this same technique. You should do in your working note. This is your production cost 11.1 per unit. So now, so if you look here, sales less cost of sales. Cost of sales in the opening stock. There is no opening stock in first year, remember. And then production cost. Production was 15,000 into 11.1. If you multiply, you get this. There was a closing inventory. So closing inventory was your 2000 into 11.1. Is it? That's how you get your answer. The production cost. Closing stock 2000. How did closing stock come 2000? Look here. Remember the formula. Opening stock plus production means 15,000 is in your left hand side. In your right hand side equals to closing stock plus sales 13,000. Means the closing stock is insufficient by 2000. So you have 2000. You multiply with production cost per unit. That comes here. So then this is your cost of sales. You deduct it. You get a gross profit before adjustment, and then you deduct your under absorption. You know how this came. You get a profit. Now for March. For the month of March, the closing inventory becomes whatever the valuation of closing inventory it was in February, it becomes the open inventory in March. So this is open inventory. And then your production cost. Production cost here, so your production, if you look at March, is 15,000. So 15,000 into production cost per unit 11.1. Production cost per unit remains the same for both the months. That's it. You don't have closing stock in March, remember that. So since you don't have it, your cost of sales comes to 188,700. Deducted, you get a gross profit, and then the rest follows as done earlier. So that's how you solve a question. Now we will be talking about reconciliation of profit between absorption costing and variable costing. So basically the profit between absorption costing and variable costing will vary because of the reason. Absorption costing has considered the fixed manufacturing cost as product cost, while variable costing has not considered the fixed manufacturing cost as part of its product cost. So to reconcile the profit, this is the format you need to remember. A plus O equals to V plus C. Keep this in your mind. This mnemonic code is very important because in your MCQ questions you might have to solve the reconciliation. You might have to get your answer by reconciling it. So what do they refer? A refers profit as per absorption costing and the O out here represents fixed manufacturing cost in opening stock. Fixed manufacturing cost in opening stock, that will understand how to do. V profit as per variable costing. C means fixed manufacturing cost in closing stock. So remember, C is closing stock, O is opening stock. All you need to remember is the word fixed manufacturing cost in front of it. So we'll have a look at an example to get it done. So this was our income statement which we just studied earlier. And this is our income statement on absorption costing. Now if you are asked to find out the income as per variable costing, we will use that equation and get the answer as follows. So you will need this data per corresponding, you will still need it, so I put it here. Now this is your answer. Reconciliation of income statement. So the hint I have put here, A plus O is V plus C. Now since we got the profit as per absorption costing, you have to start from A. So profit as per absorption costing, put it out here. See, this amount and this amount is same. So in A we need to add O, right? O. So add fixed manufacturing cost and opening stock. Now how to get this answer is very simple. Put your opening data value. This I am doing for the month of February. So in February opening stock was 0 into 5.5 is your fixed manufacturing overhead per unit which we obtained here. The fixed part, remember this part is not 11.1. So when you multiply this, you get 0. It's 0 because the opening stock is 0. Then if you look at this equation, C comes inside, becomes minus. So less fixed manufacturing cost in closing stock. Manufacturing cost, it's not costing, it's cost. So closing stock we had 2000 in our earlier solution for the month of February, remember that. So 2000 into, again you multiply with this rate 5.5, you get 11,000. So when you add 0 and subtract 11,000, you get 10250 as a net profit as per variable costing. So that's how we prepare our reconciliation statement. It's very simple. So what if your profit was as per variable costing? If you had got profit as per variable costing, suppose this is as per variable costing, you will have to start your heading as net profit as per variable costing, this V. Then you will have to add C. Add C means you will have to write add fixed manufacturing cost of closing stock. Clear? Then you will subtract O, because when O comes it becomes minus, less fixed manufacturing cost in opening stock, and that will give you the answer as net profit as per absorption costing. So that's how you do it. So I guess this presentation helps you a lot. Let me know if you have any queries. So thank you everyone, see you again.